Credit score secrets, what lenders are actually looking for before pre-approval. So you're buying your first home. It's the American dream, but let's be honest, the process can feel opaque, confusing, kind of like a secret society. In my opinion, it should really be a topic taught in school. One of the biggest gatekeepers, your credit score. So let's get into it and demystify that process. So when you apply for a mortgage, you're asking a lender for hundreds of thousands of dollars and maybe more, depending on your market, and they want to know that you're a safe bet. So your 3-digit credit score is one of the major windows into this. Now you can usually see an estimate or a snapshot of this in your banking or your credit card apps. It's not always exact, but it's a good estimate. So for first-time home buyers, a higher score means a lower interest rate, which of course can save you a lot of money over the life of the loan. Now, while the magic number for this, for a lot of banks, is usually 620, sometimes higher, we can go as low as 580. But the higher your score, the easier your approval is, and the better your rates can be, but we can go low if that's what you're working with. And I'll just talk to your lender. Now, pre-approval isn't just about the actual number, it's about the story that your whole credit report tells, and that's why we do a deep pull of your credit. So here are some of the biggest factors. Lenders focus on a number of factors, but a couple of them are of higher importance as it relates to your score. So factor one, your payment history. This is a very important factor. Lenders want to see a consistent, on-time payment record for all your debts. Credit cards, student loans, auto loans. Why? Because your past payment behavior is the best predictor of whether you'll pay your mortgage on time in the future. Lenders look for frequency and recency. So example, a single late payment from 5 years ago hurts less than one from last month. A good goal is never to be late or miss a payment on any of your recurring accounts. And this includes credit cards. Kind of common sense, but it really has increased importance as far as mortgage lending. Factor two, your credit utilization or account balances. So this is another very important factor, and it's not just the total amount of debt that you have, but how much you're using your available credit, which is also known as your credit utilization ratio. The secret, keep your total credit card balances below 30%. You might have heard this before, of your credit card limits. The goal is to keep this percentage low and stable. So for example, easy example, if you have a $10,000 limit, you want your balance to be under $3,000 when your statement closes. So paying your cards down significantly before you apply for pre-approval is a quick way to boost your score and just kind of help yourself out at the very start. Factor three, length of credit history. So this considers how long your oldest account has been open and the average age of all your accounts. So a long, well-managed history shows you've been responsible for years. Secret, do not close old, unused credit cards. It's kind of counterintuitive, but before applying for a mortgage. Even if you don't use them, closing them shortens your history and reduces your available credit, which can actually lower your score. If you have no revolving credit at all, which I've experienced this before, for a long period of time, then we may have to reopen accounts and reestablish credit. So even if you got a bunch of money in the bank, we might have to wait some months to reestablish credit in order to get you to approval. So keep a revolving account active and paid off is key. Factor four, new credit and inquiries. So this looks at how many new accounts you've opened and how many hard inquiries you've had recently. Secret, and this is critical, avoid applying for new cards, credit cards, store cards, car loans, in the 6 to 12 months leading up to your pre-approval, unless of course you're advised to do so by a credit repair specialist or your lending team. Multiple inquiries signal that you're desperate for credit, which is a red flag to lenders, and we do see this all in your credit report. Examples, if you're thinking of shopping for a new car, we all experience that at some point, but you also want to get approved for a home loan, talk to your lender first, and likely the advice will be to get into the new home, get that loan secured, get that underway, then you can go car shopping. So bonus tip, call this pre-closing freeze. If you've got your pre-approval letter, you've got a house under contract, great, you're not at the finish line yet. Lenders are going to pull your credit and check your employment right before closing. Write this down. This is where a lot of first-time home buyers make a critical mistake and trip themselves up right before closing. So what not to do between pre-approval and closing. Don't make any major purchases. That new car, furniture for the new house, even appliances bought on credit will increase your DTI and could damage your loan. Don't apply for any new credit, not even store credit cards for a small discount. Every inquiry matters. Don't close any credit accounts. As we discussed, this hurts your credit utilization and history length. Don't change jobs. Lenders want to see a stable 2-year work history, which you'll already have discussed in your pre-approval, but even if you change jobs last minute to a seemingly better, higher paying job, this can pause or complicate the approval. So no major changes on any financial front until you cross the finish line. Don't make undocumented large cash deposits. Might seem innocent enough, but if you get a financial gift from a family member, friend, whatever, talk to your lender first. There's a specific process to document this and to make sure that this doesn't complicate things. So, simple rule, maintain the financial status quo. Do nothing that changes your score, your debt, or your income situation. Credit score is not a barrier. View it as a map. So if you understand it, you communicate about it, you manage your debt to income, you can take control of this process and prevent any hiccups, and instead use these as guideposts. And if you take nothing else away from this, take it that your lender is your partner and your ally in this. They're our best first stop for questions and advice. So what do you do if you don't have a lender? Go start talking to anyone. Send a message to me, send a message to someone you know, but get that lender on board as the first member of your home buying team.